In today's video, I am going to be breaking down the ETFs ZEB versus ZWB. These are both Canadian bank ETFs and they're slightly different from each other. So let's get down, let's check them out and see which one is technically a better investment. So the first one we're going to look at is ZWB. The main difference between ZWB and ZEB is that ZWB is a covered call ETF, while ZEB is not a covered call ETF. So what is the difference between these two right off the bat? Well, right off the bat, a covered call ETF basically holds stock and then sells calls against the underlying asset that they hold. So basically, you can make more of a dividend, more of an income when you're selling covered calls. Essentially, what you're doing is basically selling an option to somebody so that now they can purchase the stock at a cheaper price at a future date, as long as in that future date that stock hits whatever goal that call option was sold for. So for example, if the stock is currently selling for $60 a share and you sell a call option against it to say in 6 months that stock is going to be worth $75, and then somebody pays you what's called a premium to be able to buy it at today's price 6 months from now when it's worth $75. Meanwhile, you collect the premium, you keep that. If the stock never hits $75, you keep your shares. That person who bought the option is now out of that option. They lost. It's basically like a casino bet, I guess you could say. And meanwhile, you're keeping the premium. So essentially, you are playing casino while the other person is the gambler. But in a way, you're also gambling with that ETF, mainly because you now don't know what's going to happen in the future. So that's why it's a bit more riskier than just basically holding the stocks long term. However, with BMO and CI covered calls and most other companies, they'll only sell covered calls against 25% of their portfolio. So you're never going to be losing every single one of your stocks. You just might have some hiccups here and there whenever the stock market kind of just jumps like crazy. So to start with ZEB, what are we getting? Well, we are getting a yield right now currently of roughly 3.25%. So for example, if you were to buy, let's say $100 worth of this ETF, you would be getting roughly $3.28 every single year as a dividend. That is divided by 12 because this one pays a monthly dividend. Its management expense ratio is 0.6, which means that for every $100 that you put into this ETF, you are going to be paying BMO 60 cents out of what you then bought in at. Now, what you're hoping for with the expense ratio is for the underlying asset, your $100, to go up more than 60 cents a year, or 0.6%. The reason for this management ratio is, of course, they are managing your money for you, which could be pretty pricey depending on what your goals are. Now, for most ETFs, this is kind of cheap. When you start looking at mutual funds, this is definitely cheap. Mutual funds are usually 2, 3, 4% at max. And of course, as we said, the distribution is monthly when it comes to getting your dividend. Right now, it's paying around 10 cents per share, which is pretty good. And as I was mentioning, you do get it every single month. Now, this is the part where I basically mention about this ETF that it's actually quite expensive. And what I mean is, when you're holding this ETF, you are holding Bank of Montreal, CIBC, Royal Bank, National Bank of Canada, TD, and the Bank of Nova Scotia. That is it. You are just holding the big 6 banks. That is all you're holding with this ETF. Meanwhile, in my own personal opinion, considering that this ETF is only 6 stocks, why not save that 0.6% and create your own Canadian bank ETF by holding the ones that you like the most? So for example, right now, I personally really like Bank of Nova Scotia, TD, CIBC, and That is what I really like right now. BMO is another one that's in my top 4 list. Royal Bank should be, but I just have never bought into it. I probably should, and I probably will someday. However, right now, you could literally just make your own version of this, and you could probably get pretty close to the same benefits from it. You're going to get the same rate of return. It really doesn't matter because they all tend to move in motion in a way. However, recently what we can see is that Bank of Montreal as well as National Bank of Canada have moved highest the most. So because of that, they may move higher more in the future, or it could be the stocks that haven't been favored as much. For example, the Bank of Nova Scotia might then turn around and be the higher movers, and then the others might not be. You have to make that decision yourself. However, this ETF makes that decision for you. If you didn't feel like making the decision, you can blame other people for not having the returns that you could. However, at the same point in time, it's only 6 stocks. You might as well do it yourself. Because at 0.6%, when it comes to the expense ratio, if you're spending $1,000 into this, you're now looking at $6 a year and paying BMO. Or if you're looking at, let's say, $10,000 into this ETF, you're now looking at $60 a year going to BMO. Meanwhile, you could have just been saving that money and keeping it to yourself. And as you can see in ETFs like ZEB, there's a few other ones around. You'll see that from 2017 until 2020, they pretty much traded sideways. Every single bank except for, I think it was, if I remember correctly, just National Bank of Canada, National Bank, as well as BMO and CIBC, they all slightly rose during this time. Meanwhile, every other bank, the heavier weighted banks, were trading pretty much sideways. Meanwhile, with ZWB, it is a covered call strategy, so you are going to be getting a higher yield. As of right now, 5.8%, because you are making money off of those premiums. As I was mentioning, the portfolio strategy is that the BMO Covered Call Canadian Bank ETF has been designed to provide exposure to a portfolio of Canadian banks while earning call option premiums. The fund benefits are, it's designed for investors looking for higher income. So for those, for example, who are maybe retiring and looking to have a higher yield, because for example, at 5.7%, if you were to invest, let's say $100,000 into this ETF, you would then be making $5,740 a year. And then if you had, let's say, $1 million by just adding an extra zero, you're essentially adding an extra zero here to $57,000 a year. And that's considerable. You could actually literally live on that much money and never touch your retirement savings. So for all of those people who say that you can't retire anymore with $1 million, you still can. Hell, you could retire with $250,000. You just have to pick your investments wisely. You have to know which investments will give you the highest yield. So for example, another covered call ETF that has nothing to do with Canadian banks is TXF, that I think right now is around 10.5%. On $1 million, you're looking at $100,000 a year. So at that point, you're still not touching your principal. You're still not touching your retirement savings. So for anyone who says that you can't retire on $1 million, you're wrong. This one also does pay a dividend every single month, and this one's expense ratio is a bit higher. It's mainly because you are having those call options, which do take more time when it comes to the fund managers. This one did recently raise its dividend from 8.5 cents to 10 cents, which is nice to see. You always want to see dividend raises when it comes to these types of ETFs. Sometimes you will find that covered call ETFs will lower a dividend temporarily. That's sometimes maybe because they need to buy back a couple of the shares to have that fund. Maybe they just sold too many call options and the prices skyrocketed and they lost some of the shares, so they're using some of that premium to buy more shares back. Or it could be just the fact that they've been holding off on selling as many covered calls as they were before, mainly because they see that there may be a massive rise in the stock market. Now, as I was mentioning, this is going to be extremely heavy on the Canadian banks. You're going to be seeing all 6 of the Canadian banks. It's also holding ZEB, which is what I was breaking down earlier. And the reason why they do this is because, of course, they're only selling options on 25% of the portfolio. So with the largest portion of this portfolio being 28%, we can really see that they are looking to have the safe bets as well as obviously the more riskier bets with individual stocks. However, we can also see, if you go to their website, you can see what their current call options are at. So you can actually basically forecast where some of these may be falling for future equity growth or not. So for example, we see that the Bank of Nova Scotia July 16th call option for $83. It's currently July 11th at the time of recording this video, and Bank of Nova Scotia currently trades at $78.90. Do we think that this Bank of Nova Scotia call option is going to be rendered basically useless because it has not reached $83? Basically, by Friday of this week, we need to see Bank of Nova Scotia close under $83 per share, and if it does, then this ETF will do very well. However, if that Bank of Nova Scotia call, if the bank itself closes above $83 per share, you're going to be seeing a slight hit to the actual underlying equity of this ETF. And you can actually make a couple of quick trades really, or even get in when that stock goes down because of those options. And you would generally do that not this week, you would do that on Monday, because the options would then be closed at the closing of the market on Friday. So you would want to see what happens to this ETF on Monday when it opens up. You really want to, when you're looking at covered call ETFs, you want to see when those covered calls are being basically fulfilled, and if they are being fulfilled at a higher price, then that stock is going to generally go down because it's going to be losing some shares at whenever those call options were made. However, at the same time, you are able to see, hey, that ETF stock price may not have a fall because that bank may not reach $83 or whatever it may be. So you can actually get some pretty good deals if you just look at the call options really quick that they have open, and then you can say, well, you know what, this is not going to hit that, this is not going to hit that, that's not going to hit that, we're all set. So for example, one more is July 16th $90 call option on TD, currently trading right now at $84.70. Will this stock go up $5.30 by Friday? That's a good question. Right now, there's a lot of negativity when it comes to the Canadian banks charts. For example, TD just had a double moving average cross, which is not good. That stock's going to fall back down most likely. And then we just recently seen it with CIBC, where they had a little bit of a negative chart sign. So will these hold? I think that these call options will just basically become void, and this ETF will do quite well for at least the next couple of months. So definitely look at the call options that are on the table of these covered call ETFs, because then you can see in the short term where that stock price is going to go. Anyways, I hope that you've enjoyed today's video. If you have, hit that like button and subscribe. I'll see you guys again next time.